I wanted to start more broadly on the budget itself. Your estimate, because the government calls this budget fiscally responsible. Do you agree with them?
Well, fiscal responsibility can be measured very different ways. You can look at whether it's a balanced budget or not. You can also look at whether federal finances are sustainable over the long term. So depending on who you talk to, responsibility, fiscally speaking, can have various definitions. But if we look at a very long-term perspective, whether federal finances are sustainable in the longer term, we will look at that when we do our fiscal sustainability report, which we typically do every summer. So next time should be this summer, July or August, and we'll have a much better assessment of the viability, long-term viability of federal finances. And
you told my colleague Vash Capellos on this very show that they really did sort of have a narrow window in terms of spending without raising taxes. This is $39.2 billion in net new spending. Did they strike that balance and thread that needle for you?
Well, that's based on the fiscal guardrails that the Minister of Finance had herself set last fall. And she had mentioned that she would aim for a debt to GDP ratio on a downward trajectory, as well as a deficit of 1% of GDP or less in 2026-7 and onwards. And we see that the government barely made it, especially on that last aspect, given the additional spending that is included in the budget. So it's indeed threading a very fine needle or walking a fine line, whatever the expression is. So they were able to do it by increasing taxes, notably on tobacco and capital gains.
I want to talk about capital gains. They said it really will only affect about 0.13% of Canadians. Do you think that money that they say that they will recoup with it, the $19.3 billion over the next 5 years, is that an overestimate on their part, or do you think that that is realistic?
It's difficult to determine because there's, on the one hand, the increase in the capital gains inclusion rate, but on the other hand, there's a $250,000 exemption or tax at the current rate every year for individuals, plus an indexation of the small business lifetime capital gains exclusion. So there's a couple of things that happened at the same time. So it's very difficult to determine whether they will be able, like just looking at the numbers, whether they will be able to meet that target when it comes to the overall revenues being raised by that measure. We'll be assessing that over the next couple of weeks, but my suspicion is that in the first year, they will probably meet the revenue targets of $6.9 billion, I think, as people have time to advance some capital gains disposition of assets to trigger them before the higher inclusion rate enters into force, which is June 25th. So, and that part is a bit unusual too, giving 2 months heads up to taxpayers so that they can arrange their affairs to avoid the higher taxation rate.
Did they make this in terms of giving that actual sort of lead time for people? Did they make it so it will capture enough people, or is there enough time for, as you had mentioned, concern over a wealth tax, that people would just move their money around to avoid it?
Well, I'm not sure that people will have, well, they do have time to move their money around if they need to. But what is surprising with that 2 months heads up is that people don't even need to move their money around. They can just sell some stocks or bonds or assets that they have between now and June 25th and still benefit from the existing tax rules before the new inclusion rate comes into force on June 25th. So they don't even need to move money around. They just have to sell their bonds or assets, as I said, a little bit sooner than maybe they had anticipated, and they still benefit from the 50% inclusion rate.
So then, do you think it'll be effective if they are giving the people that 2-month notice that they can do what you just said? It almost sounds like some of that revenue that they're anticipating may be gone.
Well, I think the revenue in the current fiscal year will probably be higher than we would normally see because of that, like advanced sale, people taking advantage of the current rules. But in subsequent years, then we may see lower than expected revenues as people have had time to adjust their behavior and put their business in order so that they can benefit from the lower capital gains inclusion rate.
With that capital gains inclusion rate now affecting businesses as well, do you think, is there any concern on your part that it could depress growth and investment in this country?
That's an interesting question because the capital gains inclusion rate is going up. So it's taxing capital gains at a higher level for businesses and individuals above 250,000. But on the other hand, there's the lifetime capital gains exclusion limit for small businesses that's going up, and there's an additional exclusion on lifetime capital gains for certain types of businesses. So on the one hand, some sectors will see lower taxation of capital gains, but the bigger the capital gains will be taxed at a higher rate. So it's difficult to assess which of these two offsetting impacts will be prevailing. The beneficial aspect for smaller capital gains or the higher taxation rate for much larger capital gains.
There may be some people at home watching this and concerned that this, the inclusion rate and the capital gains will affect them in the sense that a lot of people in the past have bought properties as an income property and maybe looking to sell that off. And they're concerned that that type of investment that they had, that they were maybe going to use as a pension, may be affected. How much do you think that'll affect those people?
Well, it will affect those with significant capital gains. So anything above $250,000 per person will be taxed at a slightly higher rate. So the inclusion rate of capital gains will go from 50 to 2/3, 50% to 2/3. So,
and that's likely a lot of people because of the value of real estate that has gone up so much.
Exactly. Cottages or secondary homes or residences, that will be captured by that higher inclusion rate. The moment you have a capital gain that's higher than $250,000, then you're captured by that higher capital gains inclusion rate. So it will affect people with secondary residences, or as you mentioned, rental properties, or real estate, or even if they're successful, bonds and stocks.
Because it almost seems like that is something that maybe this government didn't really contemplate. People who have income properties as an investment going forward for their pensions.
Yeah, it may be one of the collateral damage of this measure, but I think that the government, by introducing a $250,000 limit on that higher inclusion rate, meant to capture middle income or middle class individuals who trigger capital gains every once in a while, maybe once in a lifetime when they dispose of important assets such as these. But the question is whether that base amount is sufficient to cover many situations. As you mentioned, the price of real estate has experienced significant growth over the last several years, so it's not unusual for capital gains to be realized well in excess of $250,000.
I just want to close on the disability benefit. You had run a number of models last November on what it could look like and how much money it would actually take per year per person to really close that gap. One of the models that you ran said that it would take about $14,356 per year per person to close that gap. What we're seeing here with this government really is on the low end. Talk to me a little bit about how much this falls short, even though you had a model that was around this level as well.
So last fall, we saw that the legislation enabling or giving authority to the government to introduce a Canada Disability Benefit had received royal assent, but with virtually no detail. Everything was left to regulations. So that's why we decided to have a model to give ideas as to what different scenarios could end up costing. And our low end of the range was $2 billion, and it was up to $20 billion. And at the $2 billion per year benefit, my office was criticized for tabling or putting something out that was unrealistically low. So when I saw that the government is planning to have something that will cost around $1 billion per year, I can only imagine the reaction that these stakeholders group will have.
Now, the government says, the minister says that it only begins to meet. This is sort of the starting point. But it almost feels like this won't even go anywhere to help lift people out of poverty. Is that the case in your estimation?
Well, when you have a benefit that provides $200 per month, I don't think it will help, but I don't think it will go nearly as far as some people had expected. And in addition, in the budget, the government talks or calls on provinces to not claw this back from provincial benefits. and there's no guarantee that provinces will do that. So it's a good first step, but I think the government was caught in a difficult situation of delivering on a promise, but at the same time not breaking the bank, given all the fiscal constraints it's faced with.
Last question for you in the last 30 seconds. Do you think that there will be pressure on them now to try and scale this up to actually have this benefit make a difference for people?
Well, the government is faced with many pressures all the time. I haven't looked at all the reactions to the budget, but I imagine that many stakeholder groups had higher expectations when it came to the disability benefit. You mentioned one of the models we had was for $14,000 per year in benefits. So I'm sure that many stakeholders and individuals had expectations that the benefit would be in that ballpark of $10,000, $12,000, $14,000 per year. So I think there will be pressure on the government to increase its $2,400 per year.
Okay, we're going to have to leave it there. Yves Giroux, Parliamentary Budget Officer, thanks so much for joining us. Appreciate it.
My pleasure.